Okay, let's look at a company that I find very interesting, and that is Knutsford Express. So, quite a bit has been going on with them, and their first quarter results are out. I'm expecting good numbers, but you give us the news, Leo.
All right. So Knutsford Express came out with numbers recently, as I said, first quarter, indeed, August 2023. All right. So if I can just share my screen here, we'll just go through it. If you look back a bit, you can see that they've, going back to 2019. So for context, their year end is May, right? Now, when you go back to then, you can see that they had 188.5 million. Fast forward to May 2023, you're looking at $304 million, right? So they've
You have to zoom in on these numbers, Leo.
oh, yeah, so you can see that there's an overall improvement in the profitability, right? Now, if you look on, as you just mentioned, the most recent quarter, what you're seeing in that quarter is that you're seeing an improvement in profitability, but it's marginal. So it's just a 2.3% profit. The revenue growth is a lot more impressive at around 18.5%. Now, the major thing that kind of held them back was the growth in expenses. So that went up over 20%. Now, one of the reasons that might have drove that was increase in staff costs. Now, part of the reason that I put on that is that they're increasing staff to help with their expectation for increased demand for their product in order to drive the customer experience. So, I mean, as it is right now on the surface, it doesn't look that good, meaning profits up 2%. But if you look at it in context, though, throughout the history, that quarter, that first quarter number was actually pretty good. So marginal improvement over the same period last year, but overall, it's still a big one for them. Now, if you look on their balance sheet now over the time, you can see that that steadily improves. If you look on first the total assets, you can see that that steadily improved over the period. So you can see the growth there and that. You can see similar things showing up, similar pattern on their non-current assets, their current assets. Similar, look at dip here in 2021, but still overall improvement that you're seeing for them. And when you fast forward, you look on their equity, you're seeing a similar trend. So it fell a bit here, which coincides with the fall off in profitability in 2020 and 2021. And of course, a lot of that was because of COVID. And we can see again, they're fully recovered from that and then some, right? Putting out record numbers for them for the financial year. If you look on the cash flows now, operating cash flow, that's very strong too. So that's the highest that you see over these 5 years here. So 435.1 million. So that's also looking good for them, right? If you look in the most recent quarter, it's a 15% increase in operating cash flow, which is good. That's something you want to see. Because remember, with companies, these financial companies, at the end of the day, cash is king. So when you're seeing that kind of strength in the operating cash flows in particular, that's very good for the long-term viability of the company. Now, I'm just going to look on a few ratios here, because I don't have time to go through all of them. So when you look on these ratios, you're seeing the current ratio at the top here. Now, that one is up for them. So you see, over the period, it's been in excess of 1 times, which is something that you want to see. Matter of fact, the lowest that you have here is 1.5, and currently it's at 2.2. So what that's really saying is that their current assets is more than 2 times their current liabilities. So you can see that any near-term obligations that they might have, they can easily solve that with the current assets that they have, clearly covering those current liabilities. If you look on the debt to equity, which is one of the measures that you can use to look at the solvency of the company, that's also very low. Now that's positive, because if you understand it's debt over equity in the equation, so what that means when the number is low is that the equity of the company exceeds its debt. So that puts them in a strong position. So if they were supposed to go out, try and borrow money, increase your debt load, they could. And they could possibly do so at a very favorable rate because of the current structure of this. Now, when I say favorable, it's relative because everybody's paying higher interest rates in this market, but it's just that they might be on the lower end of those higher interest rates because of this current structure. So that's if they want to do it. And then if you look on their ROE, that's very strong, 33.7%. And for context, if you look on the broader junior market, the average is around 11%. So that's very strong in terms of their ROE, and of course strong net profit margins and so forth. So now moving on, let's take a quick look on the performance of the company. All right, so the performance of the stock, sorry. So what we're seeing is that it's a 42.4% year to date. Now that's way above the junior market, which is actually down about 2.5% for the year. So that's very good. If you zoom out a bit, you can see that this company has done well for investors over the years. There's 3 years, 20 calendar years, 2018. I don't know if I probably have to zoom this a bit. 2018 to 2020 when the stock wasn't doing so hot. So those years it was down 13, 18, and 36%. Right? But other than that, the stock has basically been a winner every calendar year for investors. So of course you can understand the reason why I like to bring up this chart is for investors to get an understanding of how performance can vary over time. So for example, with any stock, it will have its bad years, and if you're in the market at the time, it might stand out in your head as, boy, I don't like stocks and I buy nothing because it's too risky, all of my money burn up. But the thing is, when you look at it on a longer time frame, you can get an appreciation for, yes, there's volatility, but there's also you can get strong rewards associated with that volatility. Again, you practice proper portfolio management, you mix that with diversification, you can actually get some good results from the stock market. Again, of course, we know this year isn't the best for the stock market, but the stock in broader in general, what you can see, when you invest in stock. On here, same chart, same stock, but just in a different perspective, we can see that the stock kind of peaked out back in like calendar year 2017, fell off significantly, going into COVID and all of that, and it's recovered. Not all of it, but it's recovered quite a bit for investors there. All right, so moving on to the trading activity, not a very liquid stock. So basically, if you're a very high net worth individual, institutional investor, this is gonna be difficult to trade because what you're seeing here, the average traded daily value traded is less than $500,000. So you're looking at probably like $350,000. So you can understand high net worth individuals, institutional investors, small retail client, that might not be a trouble for them because they might, when they diversify, key size for them. So that's fine. So you're looking at the valuation, price to earnings ratio is around 20 times currently. Average over the last year is about 20 times. Now, this is a little bit above the junior market. The harmonic mean on the junior market now is around 17x. It's a little bit above that, but again, as I alluded to earlier, the ROE on this company is very strong compared to the overall market. So that the marginal premium in the PE may be justified based off that. So that's basically it. So all in all, it's a good number. It's not great in terms of the return, in terms of the increase, but if you look at it on a holistic standpoint, which is very important, you can see that it's really strong in terms of the balance sheet, cash flows, the profitability of the company. It's really good. And of course, the stock price performance year to date has been brilliant. Not very liquid, so that's kind of summing up everything here. So it's not very liquid, but that's the case as it is. So yeah, so that's it. So,
I was actually expecting it to be somewhat better given how robust tourism has been this year.
Yeah, the tourism did contribute to the strength, but again, they're coming off a very strong August 2022. So tourism was also strong then. So remember, this is the trick when it comes to companies' performance, is that whenever you put up good performance, in one way, you kind of make it harder for yourself, because what happens when you put up good performance, you get a lot of clients, you get booming business, is that you have to repeat that and then some the next year in order to look good again. So if you look on the previous year, if you look on August 2022 compared to August 2021, that was pretty good. But then because August 2022 was such a good number, their ability to exceed that now in August 2023 is very difficult. So the fact that they can even meet it is decent. You have to give them kudos for that. But
Gotcha.
like a 50% increase of that number, I mean, it's possible, but it's hard. So that's one of the things that I always caution investors against. When you see a company growing rapidly, like 1 year profits up 100%, next year it's up like 150%, and then people start pricing it as if that rate of return is going to continue into perpetuity. I think that's not wise, because especially if that company does like really good growth after 2-3 years, them flattening out on the third year is almost a guarantee. Them even declining is even possible, because when you put up those kind of growth, unless you're coming from a really low base, like negative profitability or like a COVID type scenario, it's really hard to keep putting up those numbers. So yes, the Draxol is working out for them, but that was in last year's numbers too. The tourism is working out for them. Of course, the transportation or the packages, that's working out for them, but that was also true the same Q1 last year. So yeah, so that's the dilemma.
What's interesting too is that we just saw some news in the transportation industry. We saw where buses and taxis have gotten a fare increase. Well, taxis in particular have gotten a fare increase. So do you think this will impact Knutsford in any way, or it's just two different markets?
Yeah, I think it's more two different markets. I don't think their pricing would be that would be impacted by that. Yeah, I don't foresee it being a material having a material impact on their business, because it's a completely different market segment in terms of their customer base versus the
Right. So Sean has a question. Sean wants to know, why is Knutsford so afraid to give out dividends? 9 years, just one dividend. Why is that?
I don't think it's not. No, I don't
Not
think that.
true?
No, I don't think that's true. I think not sure when they declared the last one, to be honest. But I know that they have paid historically though. Because if you look on their cash flow statements, at least going back to May 2020, there might be a more recent one, but I know at least going back to them, in terms of that financial year, they did pay a dividend, $40 million. I don't know how much I work out per share, I could calculate it. But yeah, they have paid those. So it's not 9 years of not paying dividends. You could argue that the dividend yield isn't great, but I don't think you can say they haven't paid it.
So Leo, Knutsford Express declared a dividend of 13 cents and paid it out on the 20th of September. That was $65 million. And
this year?
Yeah,
September this went, Kalilah. September 29th this went. They just paid a dividend of 13 cents per share, which is $65 million. May multiply it out.
Okay, yeah, so that's actually higher than 2020. So I mean, yeah, so I guess
So Sean, you're late, man. You missed the dividend last month.
Yeah.
And for context, Kalilah, my first dividend was actually Knutsford Express all the way back in 2016. So it's not the company isn't paying dividends, but context, Knutsford Express would have been listed on in January 2014. So next year, 10 years, they'll be on the JSE. You have to context here is the fact that 2020, 21, 22, they were not in a financial position to even consider a dividend, because they've arrested the Draxol project, and they've had to also continuation on the US operations and the slowdown and decrease in activity. So those 3 years, they were in place to really pay the dividends. So before COVID, it was stable and consistent, but after COVID came, they had to really recalibrate and just get back on track.
Right, and Javon is noting that too. Knutsford was operating at a loss. It's just bouncing back, hence the reason it wasn't paying dividends.